Hello, hi. Jerry Miller from Trendsignal here, the trader education company. This week we're going to be looking at inflation, or more importantly, the battle with core inflation. And I'm going to start really by trying to explain the difference between what is described as headline inflation and core inflation. Typically, headline inflation is what's reported in the media. That's the main one that includes the price of all goods and services. But actually, it's not the one that central banks really look at, and that's something that's called core inflation. First of all, headline inflation, what is it? It's basically a measure of all the prices of all the goods and services that consumers use. The agency that calculates the inflation rate monitors a basket of goods and services that consumer use. And here in the UK, it's called the ONS, or Office for National Statistics. And that's the agency that's in charge of collating the prices of several hundred, in fact, over 700 different items which make up inflation. Um, Core inflation is a similar index that measures price changes of goods and services, but which excludes food and energy. And you might be wondering, well, why would you exclude energy, which is the main reason why inflation has gone up? But one of the main reasons is that because it's the reason why a lot of inflation rates have gone up. It's actually more too volatile to be included in the core rate. What central bankers need and what policy makers need is something that tells them what the sort of hardwired longer term inflation is. With energy prices, with crude oil going up to $130 plus after the war in Ukraine and then settling back now to, gosh, $80 a barrel, some sort of 20% below where prices were when Russia invaded Ukraine on the 24th of February. We need to know what inflation is existing after those more volatile price movements in the likes of energy and food. And that's really the difference between headline inflation and core inflation. And needless to say, it's the core inflation that central bankers are most concerned about. Right, let's just go to the next slide. Recession versus taming inflation. Well, as I've just alluded, the thing that worries central bankers most is the strength of underlying or core inflation. And this is where inflation becomes more difficult to tackle as workers demand and receive higher pay settlements. And as a result, service and manufacturing costs pressure further price rises. And these price rises feed further wage demands. And so you can see how it all sort of feeds on itself, and it results in a spiral in inflation that central bankers will be keen to dampen down. Already, core inflation is appearing more stubborn to the effects of current rate rises, and it's the measure that central bankers are most worried about. We've already seen it in the US with a fall in inflation the previous month. We've got inflation data actually out this week in the US, and it's something that central banks will be focusing on the core rate, not the headline rate. The headline rate's important just to see that the the, the, the momentum has shifted to a slowing in price rises, which is important for the Federal Reserve. But at the same time, it's the core, almost hardwired inflation rate that is really something that concerns the Fed the most. Okay, global growth outlook. Well, interesting. The IMF, who love putting out forecasts, as indeed a lot of people do at this time of year, they're almost certainly going to downgrade global growth forecasts this year. Um, we've got the sort of main powerhouse economies of China, the US, and Europe are all facing similar challenges on growth for actually sort of differing reasons, really. Um, Inflation is hard to put back in the bottle when it is out, and most central banks are really paying the price for being too optimistic in the latter part of 2021. And I think the risks for 2023 are that markets are too optimistic about inflation and global growth. It's sort of reality only pricks the optimist bubble when it's too late. And I think this year China is going to struggle in Q1, possibly part of Q2 as well, having pursued a zero um, uh, COVID-19 strategy, i.e., not allowing any COVID infections to develop. They've really hobbled their own economy significantly. And that is something that is going to take time to recover from, mainly because having relaxed all their restrictions, they've allowed the pandemic to just go through their population like wildfire. And as a result of that, a lot of regions are now suffering the consequences, and more people come down with the infection. And in fact, the vaccination rate in China is particularly low. They've got a particularly ineffective Sinopharm vaccine, which is a lot less effective than the likes of the mRNA vaccines and the AstraZeneca vaccine. And thirdly, they have very little immunity, as very few people have actually got COVID. So they're going to be struggling. In Europe, Europe is going to struggle mainly because of inflation and the rise in energy prices brought about by the Ukraine war. The dependence on Russian energy, certainly in the likes of Italy and to a lesser extent in Germany, has caused price rises that are just unsustainable. Um, the belief is that a lot of these will start to subside, but it is the core rate of inflation that is going to worry central bankers. In the US, the Federal Reserve was a bit late to the party in raising rates, and that's one of the reasons why the US is going to struggle, or the central bank in the US, that's the Federal Reserve, is going to struggle to put rates up enough to tame core inflation. And I think the markets remain sort of a little bit too optimistic about there being a soft landing for the US economy this year, i.e., where the economy slows but doesn't go into recession and inflation is tamed. Unfortunately, the reality is going to probably be slightly different, as inflation will remain stubbornly high, and unfortunately, the Federal Reserve will still have to push rates higher. They're currently 4.25. We're expecting another quarter point rise at the end of this month, or 1st of February, with another one rise or two rises by the end of Q2. So, global growth outlook doesn't look good. The market participants might be optimistic, but as I said, reality only pricks the optimist's bubble, when it is too late. There we go. Thanks very much for listening. Bye now.